Your mortgage rate is locked at 3%, and it has not moved in years. Your payment went up anyway. If you are a homeowner who believed a fixed rate meant a fixed bill, this is not an error on your statement. It is the way the entire system was built. Only the loan is fixed. Your home insurance is up about 46% since 2021. Your property tax climbed another 3% just this past year. And both of them ride inside the exact same monthly payment you thought you locked. The number you locked was never the whole number. And here is the part nobody walks you through. This year's increase is not really the problem. The problem is what this year's increase does to next year's. It builds in a direction you cannot see. So let me show you what is actually running underneath that payment. Because your mortgage is not one thing, it is two engines bolted together, and only one of them is under your control. Let me be fair to the 30-year fixed-rate mortgage first, because it is genuinely one of the best deals in personal finance. When you lock that rate, the lender can never raise it. Rates can double. The economy can melt down. Your principal and interest payment stays exactly the same for 3 decades. And that part is real. That part is a gift. But that is also where the trap hides. People hear fixed rate, and they assume the whole payment is fixed. It is not. I call this the fixed rate illusion. The illusion is believing you locked your payment, when all you actually locked was one piece of it. Meet Malcolm. Malcolm bought his house in 2021, and he did everything right. He shopped lenders. He locked a low rate. For 2 years, his payment did not move a dollar. Then one January, he opened his statement and the payment was higher. He had not refinanced. He had not missed a thing. He read it 3 times, looking for the error. There was no error. Here is what Malcolm did not understand. His payment was never one number, it was 2. The first is principal and interest, the loan itself, and that one is frozen solid. The second is escrow, and escrow is the engine that runs on its own. So what is escrow? It is a holding account your lender controls. Every month a slice of your payment goes into it, and the lender uses that money to pay 2 bills for you, your property taxes and your homeowner's insurance. You never touch it. You never write those checks yourself. The lender collects, the lender pays. It feels convenient. It feels like peace of mind. But think about what that actually means. Your taxes and your insurance do not care about your interest rate. They rise on their own schedule, set by your county assessor and your insurance company. Neither one has ever heard of your 3% rate. And once a year, federal law requires your lender to recalculate. They look at what your taxes and insurance truly cost, and they reset your escrow to match. That recalculation is the second engine. I call it the escrow engine. Your interest rate is the engine you welded shut. The escrow engine is the one nobody lets you turn off, and it has been running hot. Let me give you the numbers because they are worse than most homeowners think. Pull up your own renewal notice while I do this. The average homeowner's insurance premium hit nearly $3,000 a year at the end of last year. In a single year, it jumped 12%. Step back 4 years and it is up about 46%. For the typical homeowner, that is close to $900 added to the annual bill since 2021. Almost $1,000 just on insurance, just sitting quietly inside your payment. Now property tax. The average single-family tax bill ran about $4,400 last year, up another 3%. And here is where it gets strange. That property tax rose 3% in a year when the average home value actually fell almost 2%. Read that again. The house was worth less. The tax bill was higher. The escrow engine does not run on your home value. It does not run on your interest rate. It runs on local government budgets and insurer risk models, and it answers to neither you nor your lender. Let me put this on a graph in your head. Picture your monthly payment as a stack of 2 blocks. The bottom block is principal and interest. It is set in concrete. It will be the same size in 20 years as it is today. Now picture the top block, the escrow. The first year it sits there quietly. Year 2, it creeps up. Year 3, it creeps up again. Every January, the recalculation comes, and the top of the stack grows a little higher, while the bottom block never moves. After a few years, you look at the stack, the total is taller, and you swear nothing changed. Something changed. The top block has been growing the entire time, and the national average hides how violent this gets in some places. In Florida, the average insurance premium is blown past $8,000 a year. In New Jersey, the average property tax bill runs over $10,000. If you live somewhere the escrow engine runs hot, the increase is not a few $100s. It is thousands. And as text, the insurance increase does not reset each year. It builds on the higher base from the year before, the same way compound interest builds, except this time it compounds against you. A homeowner whose escrow climbs $400 or $500 this year, then more next year, then more the year after, can watch a fixed payment drift up by thousands of dollars within a decade, while the interest rate never moves a single point. If you have ever opened a statement and felt that exact confusion, this is Dollars in the Decades, where we take apart the financial machinery that was built to be confusing on purpose. If that sounds useful, hit subscribe. It is the best return on investment for your time on this platform. Now let me show you the part that costs the most, because the yearly increase is only half the damage. When your taxes and insurance rise, your lender does not just charge you the higher amount going forward. Watch what happens to Malcolm. For the past 12 months, his lender had been collecting the old lower amount into escrow. But the real bills came in higher, so the account came up short. That gap has a name. It is called an escrow shortage. Now here is the double hit, and this is where Malcolm's jaw dropped. The lender does two things to him at once. First, they raise his monthly escrow to cover the higher bills going forward. Second, they make him repay last year's shortage, and they spread that repayment across the next 12 months, stacked right on top. So his payment does not step up once. It steps up twice. He is paying the new, higher cost, and he is repaying the old gap at the same time. For that 1 year, his payment balloons far beyond what the tax increase alone should have done. Then the repayment ends, the payment dips a little, and he exhales, thinking it is finally over. It is not over. The next recalculation is already on the calendar. That is why a small tax increase felt enormous to him. He was paying for it twice. Now you might be thinking, Malcolm, the lender obviously made a mistake. Call him and fix it. I understand the instinct. But here is the uncomfortable truth. There was no mistake. The lender did exactly what federal law tells him to do. The escrow engine is not a glitch. It is the system working perfectly, and that is precisely why nobody flags it for you. There is no villain making an error. There is just an automated process quietly resetting your payment every year, while everyone in the chain shrugs and says, that is just how escrow works. The natural reaction to this is to say, fine, I will get rid of escrow entirely. I will pay my taxes and insurance myself and take back control. For some homeowners, that is a legitimate move. If you have enough equity, many lenders will let you waive escrow and manage those bills directly. Here's the strongest case for it. You keep that cash in your own account all year instead of handing the lender an interest-free float, and you see every bill with your own eyes. But be honest about what it actually changes. The taxes still rise. The insurance still rises. You are not turning off the escrow engine. You are just moving it from the lender's dashboard to yours. The cost does not shrink. Only the visibility changes. And for most people, waiving escrow trades one predictable monthly bump for two large surprise bills a year that are even easier to under budget for. Control is real, but control is not the same thing as savings. And one more. You could say, I will just pay the shortage off in one lump sum and make it disappear. You can. But that only erases the repayment portion, the old gap. It does nothing to the increase going forward. Your escrow is still reset higher for next year because your taxes and insurance are still higher. Paying the shortage clears last year's bill. It does not turn off the engine. So here is the protocol. 3 moves, and you can start the first one tonight on your phone. Step 1. Find the escrow line on your mortgage statement, not the total payment. The escrow line, specifically. Most people have never looked at it. They see one big number and pay it. I want you to find the number underneath, the slice flowing into that holding account, because you cannot manage a number you have never seen. Pull up your statement and find it. Step 2. Separate the two pieces inside that escrow. How much is property tax and how much is insurance? Your statement breaks it out, or your lender's escrow analysis does. This matters because the two engines behave differently. Property tax you fight through your county by appealing your assessment or claiming exemptions you qualify for. Insurance you fight through the open market by shopping it. Once you know which one is rising faster, you know which lever to pull. Step 3, and this is the one that actually moves money. Set a calendar reminder to shop your homeowner's insurance every single year, and do it before your lender runs its annual escrow analysis. Most homeowners ought to renew the same policy forever and never quote it again. That is exactly what the system counts on. Insurance is one of the few escrow inputs you can directly lower. A better quote feeds straight into a lower escrow, which feeds into a lower monthly payment. Shop it on your schedule, not after the increase is already locked in for another year. Malcolm did all 3. He found his escrow line, which he had honestly never noticed in 3 years of owning the place. He saw that insurance had quietly grown into the bigger of his 2 engines. So he spent 40 minutes pulling 3 new quotes, found one that was meaningfully cheaper for the same coverage, and switched before his next analysis. His payment still carries an escrow block on top of it. It always will. But now he knows the number, he watches the number, and the number stopped ambushing him every January. And this is the real reframe, so stay with me for one more minute. You were sold a fixed-rate mortgage as peace of mind. Lock the rate, sleep at night, never think about your payment again. But that peace of mind was only ever half true. The rate is locked, yes. The payment is not. What you actually locked was the loan. What you have to manage is the escrow. So stop measuring this in dollars for 1 second and measure it in something else. That escrow line is not just a cost. It is the difference between opening your January statement and feeling blindsided, or opening it and already knowing what is coming, because you watched it grow all year. The fixed rate buys you certainty on one engine. Watching the escrow engine is how you buy back certainty on the other. You did not get peace of mind by ignoring the number. You get it by being the one person in the chain who actually looks. If this clears something up, and you are a homeowner watching a fixed payment climb for reasons nobody explained, hit subscribe. We take apart one of these hidden financial machines every week. And drop a comment with one number. How much did your escrow jump at your last analysis? I read them because the gap between what people expect and what the engine actually did is the whole story. Thanks for spending your time here at Dollars in the Decades. I'm Malcolm, and I'll see you in the next one.